Hi, welcome to Main Street Macro. I'm Neela Richardson. From time to time, we like to check on the health of the consumer because they're really the crown jewel of the US economy. And while the stock market is reacting in real time to the evolving situation in the Ukraine, consumers are harder to discern in terms of their reaction. Closer to home, inflation has been a front burner issue for many, and the Fed is trying to rein down inflation by raising interest rates starting perhaps in March, but sometime this year. So, with all of these issues on the table, we wanted to ask the question, is the consumer still okay? And we looked at three main ways to measure that consumer health. One, consumer debt. Two, home sales as an indicator of their capacity to make big purchases. And three, consumer spending. Let's take consumer debt first. Well, what we know is that consumer debt is about $1 trillion higher in 2021 at the end of the year than it was a year ago. Moreover, consumers are starting to use their credit cards a lot more. We saw the biggest increase in consumer credit card debt last quarter than we've ever seen on record. But there's some good news behind those numbers too, because consumer debt as a level is still below where it was pre pandemic. And it looks like when you look at that debt relative to income, we're right under historical levels and still about where we were 2 years ago. So we're not seeing a big warning sign on the debt front. So when it comes to consumer debt, yes, it's higher, but the consumer is still okay. The second place to look is the housing market. I love housing for a variety of reasons. One, I'm somewhat of a housing voyeur. I love looking at home shows and looking up listings. But two, I began my career as an economist in the housing market. And it's great for two reasons. One, the housing market is the most interest rate sensitive part of the economy. And two, it's really the way that Fed policy meets Main Street through lower interest rates that encourages builders to construct new homes and home buyers to go buy those homes. And we saw both in January. Home sales reached a really robust pace at the start of the year, but we also saw two other things. Mortgage rates were up about a percentage point from where they were a year ago, and home prices were up about 15% from where they were a year ago. So, when it comes to home sales, yes, if you're a home seller or a home owner, things look pretty good. Your home equity is growing by almost 20% from a year ago. But if you're a home buyer, you're likely to face higher interest costs, lower inventory, and higher home prices. Now, the final place we're going to look is at consumer spending, and spending drives about two-thirds of the US economy. It's why we spend so much time looking at it as a barometer of the overall health of the economy. And here there was more good news. Consumer spending was robust at the top of the year, growing by 3.8% from the previous month. And autos led that growth. So there shows not only in home sales, but in autos, a desire by consumers to buy these big ticket items. Where growth slumped is actually in the service sector, especially for restaurants and bars that were down almost 1% in January, likely feeling the brunt of the Omicron impact, which was heavier in January than we expected to be in February and March. So the upshot is when it comes to consumer spending, it's still strong, but it hasn't completely gone back to normal, meaning consumers are still more focused on goods than on services back before the pandemic. So we're still waiting for that shift back to services. Consumers are so important to the economy, and there's still some uncertainty post pandemic about how the economy is changing structurally, as well as some global tensions that we now have to incorporate into our outlook. For more information on how the consumer is doing and how the global view is affecting consumers and Main Street, please go to adpri.org.